All right, Bismillah. Let's get it. Time now is 11:40 p.m. Friday, January 26, 2024 on New York time, EST. Anyways, I wanted to go to sleep, but told myself playbook in these trades, playbook in these setups are more important than sleep right now. And staying true to my rules, my discipline, then I have no choice, so to speak. So as usual, gonna go and review the ES futures. Today was high impact news at 8:30 a.m. and moderate news at 10 a.m. So let's see if that had any effect on price itself, and also kind of review price action from yesterday. So yesterday, I do believe sometime after 9:30 or whatever, so where we wrapped up somewhere around here during the Asia session, where I do believe we were trading below, all right, below inverted fair value gap. It's highlighted gray here, or charcoal. Likewise, this one here, inverted fair value gap. I didn't add or take away anything from the chart, except this line here, and kind of like put this 9:30 open in there, but that's out of curiosity. And I think I added the 1 o'clock opening price as well, 1:30 opening price. So midnight, 8:30 and 1:30. I think that's all. And I put this one midnight and 12 o'clock, but I don't. Midnight and 12 o'clock. I mean 12 p.m. and 1:30 p.m. I had these vertical lines on the chart. I just took them off. All right, we can take that off for now as well. And nice though. It's a nice trading day today, long and short, depending on, again, goes back to trading what you see, trading what you have edge in, right? If you didn't have edge in catching this long trade, then shouldn't have took it, right? Shouldn't have took it, right? One good trade after one good trade after one good trade, right? Stick to your rules, stick to your craft, stick to your guns. Again, keep your money on your mind and your mind on your money, so to speak. Mind your business. Mind your business. Treat this trading stuff like it's your business, because that's exactly what it is, right? So anyway, so sticking to the routine for now, we want to identify. They're going to deal with everything is kind of like dealt with from the midnight open. So when I go, okay, we kind of open within the previous day's range. So Thursday, we were inside Wednesday's range. Thursday, we are inside of Wednesday's range. And Friday, we are inside of, initially, we were inside of the previous day's range. So another inside day initially. Right? Thursday high, Thursday's low. And then we broke the previous day's high, and then we target the 2 days ago previous high. And we could just mark that out right now. And in general, you can mark out, previous day's low, but that's if you felt like it was going to go back there. So one point is that in general, the low of the day is usually during the London session. The low or the high of the day is usually in the London session. So that's that was a good sign. Right? That's a good sign. So the line that I had erased off of here was the high of the London session. Wasn't like a swing high or swing low, just kind of like the high during the 2 or the 1 to 5 time frame. So yeah, anyway, we used this 5-minute fair value gap and we saw it was heavy resistance, so why not carry it over, right? And we can see that it is still generally, even though it was violated a few times, violated here, took out the previous day's high. No, we're just gonna go PDH, right? Previous day's high. And here we're gonna go previous day's high times 2. Because why not? Right? Meaning 2 days before. It's technically what? Subtraction, but whatever. So those are technically high time frame levels, right? Because it's a daily level. So previous day's high times 2, or times 2 days ago. So it took out the previous day's high, pull back, came back into this 5-minute inverted fair value gap that was resistance, heavy resistance the previous day, came back through, took out the previous day's high, previous 2 days high, Wednesday's high, pull back, act like it was support, which it was. If you were scalping, could have caught that. And you just see failure swing 1, failure swing 2. And if you drag some of these levels over, you can see they were still significant, especially since it was resistance yesterday. Oh, turn resistance, turn support, so all significant still. Could be used previous day again because we are within and all around the previous day's range. So, and we didn't go into any higher time frame yet. We still on just the 5-minute, and that's because we were within the previous day's range, right? Inside day. All right, so let's look at here. You see the 4-hour fair value gap here highlighted still. It's still significant. You see a high, low, higher low, and again a higher low. This 4898.50 is the consequent encroachment of this 5-minute wick here that we drew out, and we did it yesterday in terms of the bodies of the candles staying above that level. And here you can see that this candle here stopped 4898.50 on the dot. This candle here at 250 during the London kill zone. Primarily, we've just been dealing with fair value gaps, inverted fair value gaps, and volume imbalances, and optimal trade entry, OTE entries, and dealing with discount premium, previous day's high, previous day's low, previous session highs, previous session lows. So here we have a run on, because we pretty much have an opportunity to map out at I'm gonna say at a minimum 3 trades. Technically I have 3 kill zones here, so that's why I'm saying 3 trades. There's more than 3 trades here, obviously, depending on your trader identity. Are you a scalper? Are you a person looking for the daily range? Would you have traded in the London session and held it throughout until just before lunchtime? Yeah, it's up to you. If that's your identity, then go for it. Are you just gonna trade the London session? Are you just gonna trade the New York AM session? or you're going to trade the PM session. And today's Friday, so the market is closed right now. So just know you can't trade the Asia session right now. Apologies, got distracted there. All right, so we have a run. We have that 3 drives pattern here. The 3 drives reversal pattern, the 3 Indian pattern, the 3, yeah, that's what I know it as. 3 Indian pattern or the 3 drives pattern. Guess if you want to be more correct, politically correct, or whatever the case. No offense to anyone. Just calling it what anyone could like recognize it by. I don't know what's going on here. What you doing? There you go. Okay. All right. You got a low, lower low, followed by a lower low. So 3 drives pattern. Which means that you can't look to get in at this level here. If you had conviction that this was indeed a 3 drives pattern, and it was, so we kind of like straightened into a high time frame point of interest, or POI, which is this 4-hour fair value gap. So we have a reason to believe that liquidity buy side has been taken. That's why you didn't have to wait for this low to be swept. So you can say, oh, price found support at the 4-hour fair value gap, or you can just look for a legitimate trade on the lower time frame, which is this one, 5 minute, and you have a run up above this inverted fair value. Let me say it what it is first. Above this bearish fair value gap, turned inverted fair value gap. So this is your first entry. All right, you can either choose this. I have more faith in inverted fair value gaps than I do in fair value gaps until I have a clear indication that price wants to continue to go higher. So that's why I kind of like emphasize inverted fair value gaps over. Okay, so we have this one. You can do this bullish fair value gap here and the 3 o'clock candle. And again, this is a 5 minute chart. So you have the 3 o'clock bullish fair value gap, and you have an entry here at 325. You have price pushing higher, trade it back into this inverted fair value gap, or this bullish fair value gap. There's also a small volume imbalance here. That's, if you wanted to use that, then that's on you. You could have. So yeah, we had one rally higher, which is the most significant break in market structure here. Pull back 2, here's 0. Second entry, so you had an entry here, second entry here at 4 o'clock. So 325 and 405, you had an entry. Stop loss would have been below this swing low here at 250. That price is 48.9850. Or you could have chose the body, but the swing low. That would have also given you an optimal trade entry for the first one. Here's your first entry in the 70.5, another break and market structure, and another break and market structure here. And here's your entry again, 61.8. And I'm using the wicks. Those are like, it could still stop you out, but this gives you more range. Now I use the bodies of the candle. This is the bodies, the significance of the bodies to the wicks. Yes, there's volume. There's volume in both, but obviously the bodies have more volume. There's more participants in the bodies than the wicks. Here's your second opportunity during the London kill zone. And of course, as discussed before, we kind of target these swing highs here. That's your entry. This would have been your first. Second, if you just targeting swing highs, but you also have these fair value gaps to contend with, which is internal range liquidity. And there you go. And here, and you have these as well. And you can see price kind of like traded into that and then pull back down. So then you have that, and you can keep going on until on and on and on. As long as you think price has enough momentum, enough force, enough strong enough catalyst to continue on, then this would be the targets, and including the fair value gaps or volume imbalances. All right, so that's one trade, that's two trades, that's three trades. Again, this is our targets, and that also means that you can literally start scaling out of your trades at these levels until you see another. So part of your trade setup is also determining where you can add to positions, and based on this time frame here, I mean, if it was your rule and you say, oh, it held above this swing high, right? Let's just draw it out. It held above this level here, right? Because it hit here, pull back, hit there again, pull back, open here, and blast it through the level. All right, if that's your trade strategy, go ahead, add on to your trade right here. Add on, right? That's on you. My strategy would be to possibly consider to enter right here, fair value gap. This price is holding above that fair value gap. I would consider adding to the trade. Right, you got another fair value gap here. Price kind of stabbed. Down, trade it back up, pull back down into it here. Right, that wasn't good enough. You could have added on here, which is another setup, fair value gap. Again, believing prior to the trade that at least the previous day's high was the target. Oh, it's actually right here. All right, so we have that. We have price traded back down. You can say this, right? We don't even need to use this one, so let's just pull that back. But we could, but you have some fresh meat, right? So inverted fair value gap found support with the new bullish fair value gap that we kind of see that price was reacting to it initially anyway. So next time that price traded into it, we want to see what price trade to it, through it, or this, some portion of it and reverse or go back up, or burst through it and continue to the downside. So, and you can see here, this is a strong key level, perhaps for the whole day as well. Same as we did over here. It's pretty much the same level. So you can literally say like, this is this is the area that price loves, right? It's a lot going on right here in particular, right? And that's just something you probably observe that's kind of going through price, throughout the day. All right. So took out the previous day's high here, pulled back into bullish 5-minute fair value gap, traded back up. You can say it traded into this inverted fair value gap that you know. So you have a bearish fair value gap here. Let's see if we can. Okay, you have a bearish one here. And that's what happened. Price reacted to it. Nested with this inverted fair value gap. Pulled back down. Then took out the intraday high and ultimately the previous day times 2, right? Previous day times 2 high, right? 2 days ago high. Then we have a pullback, obviously. Failure swing higher. So you can technically have gotten in here if you believe that buy side liquidity was exhausted. You have a pullback here. You have some volume imbalances here, but there's no gaps here. There's no fair value gap until here. So let's rely on this inverted fair value gap, even though we see that price is responding to this bearish fair value gap. We're just going to actually just move it here and kind of take note that this is still valid, right? And you can see price traded into here, drop down with force, traded back up into this. And at any point here, this was your entry. If you were using fair value gaps, if you were using optimal trade entry still, that would have been an entry. 78.6. I'm just using the bodies. So you could have got in here, better entry than the fair value gap, but sometimes you have to trade what you see and trade what you have edge in. So in any case, sometimes you may miss a trade waiting for your trade, right? So it may not, if your trade was to wait for 78.6 level to be hit and it didn't, it stopped at 70.5 or 61.8. That wasn't your trade, right? It was there, but it's not your trade. And you can, I don't want to say you can chase it by dropping to a lower time frame, but you can. But again, I would say for me, I wouldn't do that, right? Because then you won't really know where your edge is, right? You wouldn't really know what's for you and what you could depend on and rely on, right? What's your business model? It's like going to a pizza shop and getting a taco, right? Like, bro, like, is that your thing, right? It's not your thing. Mind your business, right? Mind your business. Stop playing around, man. So yeah, got entry here, and let's just say let's just use the wick, see what that brings us. We still have a nice optimal trade entry. So either case, you have some confluence here between the OT entry and a fair value gap entry. It's good money to me. I'll take it. So we covered one during the London session. Actually, we kind of skipped the price action here. It looks kind of wild, right? What was the news? 8:30 and 10, right? So we had 8:30 news, and we had 10 o'clock news somewhere over here. And we have like a consolidation. Then we have you were trading wedges, then you would say, broke the wedge, and okay, that's good. You can take that trade based off of retail logic. That's fine. Listen, again, it's all about what you see. You see it, you're willing to risk something on that, then we already discussed the fair value gap here holding price up. So, right? So the first one, again, price broke above this fair value gap. You can see it. Oh, price has a willingness to trade above the inverted fair value gap. You can make that argument too, right? Pull back, which is a failure swing lower, right? It failed. So you have a break in market structure, pullback. So you can go here, use this swing low to this swing high, technically, and you want to look for a fair value gap. And that's one here. Pull back. Technically, when you enter on this fair value gap, you would have put your stop below the swing low. And you would just have to stomach some drawdown, right? It never went down there. So it either would have been you panicking to get out, or panicking or not trusting in your trade strategy or your edge in the trade and just trading because you think you know what you're doing. Which means that you lack conviction in your trade setup or in your edge in the market. So yeah, this is legitimate, right? Because this is the rules. Stick to your rules that you agree and accept as rules. So here's your swing low here. Your stop loss would be here. Your entry technically could go here. See that? Somebody else, or later on you can find another entry here, trading above this inverted fair value gap here. So you can enter that too. Probably got stopped out here, but so yeah, just trading between two fair value gaps. And you have this here. We discussed that. That's technically during the lunch hour, which the lunch hour either consolidates or does a reversal. And we can see here, which I'm gonna just do this because colors are a neurodivergent person's best friend, depending on who you are and what time of the day or the mood you're in, whatever. So the London high here, you can kind of see also price traded back into the London high. So we discuss always knowing the previous day's high and low, knowing the range that price is currently in. Rather that's the entire range, or like here where we can say, oh, prices between this low and this high, that's also a range. But also the same way you would do with a previous day's high, you go, oh, price is holding above the previous day's high. You can also say price is holding above the previous session high, and that's this here. And then you have a fair value gap right around that area. So even if you didn't accept this fair value gap, you could have used this tiny one here. This one here in the 515 candle. And you can see that price was reacting to that small fair value gap as well. So that would have been all good in my book as well. So we got the short during the lunch session, and you can see it highlighted yellow. And the lunch session took out the AM session lows. The PM session ran the lunch session low and traded back inside the range of the London session, which we can just go, okay, this is the entire range that price was in. Let's erase that. Right? This is the range that price is in. This means that when price, like we discussed, when price goes below the 50%, we can kind of reassess our position and see if price is still going in the direction we are anticipating it, or if our trade has failed. In this case, we have an optimal trade entry long here into from discount here 70.5 to premium, because this is back above the 50%. That's that long for the PM session. Long for the PM session, but here's another entry here. Let's take this because all these colors and boxes is just getting kind of. So we kind of saw that. Here is your next entry on the PM session. You have again, this is the my A plus setup. You have a run on buy side, followed by a break in market structure. You can say that here. And so run on buy side. What am I doing? Tripping. Now, this is actually a different type of setup though. It's more like turtle soup, which we didn't cover turtle soup. But anyway, the fair value gap, this bearish fair value gap that's present prior to the run on sell side. That's our golden goose. And let's erase that and use this. Okay, so this is the A setup. A setup, A plus setup. It's very close. It doesn't use the fair value gap. It uses a inverted fair value gap, which, like I mentioned before, is my I love inverted fair value gaps more than fair value gaps. I trust them more. So we have the run on sell side. We have a run above the inverted fair value gap now because it was bearish. Now it's above. It's an inverted fair value gap. And that's also optimal trade entry long. Here, use the body. You can use body to body here. So I use this body and this body here, right? And here's your entry right here. You can see that's between 61.8 pretty much. And also the bottom of this fair value gap, 49.0850. Swing low here is 49.11. What am I? Yeah, 49.1150. All right, that's the high, 49.1150, and this is the low. This candle at 14.30, 49.1150. So that would be optimal trade entry or a turtle soup inverted fair value gap entry, targeting this relative equal highs and targeting internal range liquidity. And again, we have this. That's the one that was resistance since the previous day, since Wednesday's session. Yeah. But yeah, and again, so that reached one standard deviation. So that's a good trade as well in terms of risk to reward. Yeah, and we did the entire range here. And you see also that price is above the 50%, which means that is, let's say you were bullish and you was assuming that it would take out these swing highs. It's less probability, plus the biggest move here would be to the downside. So we are in a bearish range here. Overall, we are in a bullish range, so it gets kind of confusing. This is a much tighter range than the AM session or the London session. It's even tighter than the lunch session. So that's one of those. Go ahead and trade, but acknowledge that now your range is much tighter. It's a smaller range. Right. See what else we got here before. So body to body, this was a nice move, and we have 2 standard deviations as a target. Got 1, 2 standard deviations target. That's good. Risk to reward as well. So not sure how many trades we covered. Definitely got 1 here, 2 a re-entry, so we're gonna keep it at 2. Don't be greedy. Got an add-on. That's another add-on here. So still keeping it at 1, 2. Gonna keep all that as 2. You got in late, you could get in here or add on. Again, going above 50% of the range, it gets more. It's possible to continue going to that ultimate destination, but the odds of it kind of decreases or diminishes. So yeah, this is more risky, but it's still good money if there's momentum behind it. So you got another reason to add here, and you got this good old strong inverted fair value gap run on the sell side, breaking market structure. Technically, you have an entry again on this fair value gap over here and here. So again, this is a tight range as well, right? This is a tight range. Somehow we back in that same tight range here. And so yeah, it's opportunities. I noticed I don't actively drop down below the 5 minute. You probably missing trades, or you probably only taking your trades that's meant for you, right? So not sure. I'm just gonna chop it up to 1, 2 trades. And you can always trade these retracements. Let's say you're bullish, but or you see that price is pulling back. That means you're about to scalp something. If you're ultimately bullish, you shouldn't hold on to any shorts unless that, right, they are scalp material. Meaning that you're not getting married to that position. You're gonna do what you need to do. Whatever you feel like you need to do to keep your mind on your money and your money on your mind. So we have that. We definitely have a few trades here. I think we focus on the bullish trades. So we just 1, 2, just gonna say 3 here. Definitely 4 is here. Nice short. We have another one here, 5. So, what time is it? Oh, 40 minutes in. All right, so that concludes today's price action. You can do a little review for, maybe I should do that separately. Anyway, we have Wednesday. I kind of drew this out. This is the previous week's high. This is this week here. This is breeze through it. This is Friday, Monday, Tuesday, Wednesday, Thursday, Friday. All right, this is the previous week's high, and we can kind of see that we dip down in it. Let's go down to a 4 hour. I'm gonna start deleting stuff now because why not? Okay, so all right, so we have the previous week's high. We have a fair value gap here, and this is a 4 hour chart. So we have a 4 hour fair value gap here. You have price, and this is bullish. 4 hour fair value gap. We have that weekly open. We have price trade down. You're gonna look for entries. Price trades down. So even on this time frame, you have we can say it traded into a high time frame POI, point of interest, this 4 hour fair value gap. Traded down in, filled it up. Let's see, high here is 48.74.25. The low of this candle is 48.74.25. That's pretty significant. Price traded down, held inside of this fair value gap. You could have technically went bullish here as well, but you probably would have not stomached it, right? Unless you're on this 4 hour chart. Say, hey, enter in here, and you're gonna hold it, right? Your stop's probably gonna be down here somewhere below the weekly open. That's if you still believe it's bullish. So here you have that taken off from this bullish 4 hour fair value gap. Of course, you could drop down to a lower time frame, look for the same setup pretty much on a lower time frame, and enter when you have conviction. Or you can wait. We have a run on sell side here with this candle. Have a break in market structure, these relative equal highs, and we have a retracement back down into a 4 hour fair value gap, and we have ever so slightly a run above this swing high. Right, so that is an optimal trade entry long. Right, you could just say we're waiting for market structure shift, and there you go. That would be high probability entry. You didn't trust this entry, could have got in here, and that's on Wednesday at 2 p.m. 1400 hours, and your exit would be Friday at 10 o'clock, targeting this high. And let's see if we're going to use the bodies, what that will look like. Glorious 70.5. This would be your first scaling out, and then your first take profit, your next take profit, and targeting this swing high, which is Wednesday's high. So that's a 4 hour swing trade from, again, Wednesday to Friday. That's 3 days. Wednesday, Thursday, Friday, right? Technically it's less than 3 days, but three days, right? And so that's one trade here, guess you can technically, if that's your trade strategy, to take this trade here off of a volume imbalance. You can see price holding above that too, so that's even more another reason for you to come on in. You got a fair value gap that's it's still here, still giving you opportunities to enter, still trading below 50% of the range. It's all yours. If that's your trade strategy, if you had edge there, and you got a bearish fair value gap here, and you can use that as well to kind of take some smaller trades. Here's the 1 hour. First off, in the daily, you can see it just kind of broke outside of this range here. Break outside the range. You got last Friday, Monday, Tuesday, Wednesday, Thursday, Friday. So it's a break outside of this consolidation. Yeah, maybe you want to raise a little higher. It's up to you. So you got a couple of ways of looking at that. You go into the one time, is it 46 minutes in? About to, it's midnight 27. So this is that 4 hour fair value gap. Okay, this is Tuesday. So here you go. Yeah. So look at 1 hour, it looks kind of like, I can tell you traded in the range, but we already know it was in this inside day break of that range right here. So it looks not that appetizing on this 1 hour chart. But trade what you see. You don't see something, don't take it. Don't even consider it. So this is Monday. We were using Fridays. Guess that didn't carry over, right? This right here didn't carry over. Or did it? I'm just overlooking it. Oh, it's right here. All right. So technically we want to trade, if we were bullish, even though we're like in no man's land, you want to trade below previous week's high, right? Meaning that, so ideally you want to trade around here. All right. So you got to run on stops here. Got a break in structure here. There's no fair value gap, except like right here. And if you did enter here, your stop would be down here still. So you wouldn't have got stopped out, stomaching this, all of this action. I probably would have. Because also you have to deal with like a shot clock, so to speak, as S&P Capital says, the shot clock. So like it's like if the trade doesn't happen within like enough time that you kind of consider that trade to have worked, then you should get out, right? Rather that's at a loss or at a small gain. It's part of your risk management, part of your planning process. Because all of this consolidating, it's like Nah, right? Uh, anyway, we have a break here. We have a retracement down into this 15-minute fair value gap. So that's not bad. Tuesday entry, Wednesday exit. That's on you. Wednesday exit. You got a break. Breakaway gap. Yeah, anyway, I'm like done. I'm going to sleep, bro. Anyway, we get up another time. I love trading. This looks amazing to me, you know. Good night.